Velocity banking, pay off your house in 7 years, get out of debt fast, build cash flow, put your savings to work. There are a lot of ways people describe velocity banking. There's only one way I do: garbage. Hey peasants and peons, welcome to Tank Top Finance, where we take money seriously and not much else. I'm the Alpha Bro Brett. I'm here in the finance laboratory, and today we are talking about the gimmick known as velocity banking. Now, before you can know why velocity banking is garbage, first you have to know what it is. Velocity banking is a financial strategy that idiots who think they're smart use to pay off their mortgage early by rearranging your cash flow so that you pay off certain debts ahead of others. If you're confused, that's all right. It's dumb. And dumb things are hard to understand sometimes. This is literally a case of people thinking they are smarter than they actually are, which is something I know nothing about. First, let's start by understanding that there are two ways of borrowing money. There are lines and there are loans. A loan is where you take a lump sum of money and you pay it back over a scheduled period of time, like a mortgage or like a car loan. A line is where you have access to a certain amount of money, but it doesn't cost you anything until you actually use it. So if you don't use it, it doesn't cost you anything. Think like a credit card or a HELOC, home equity line of credit. You can use it as needed, but if you don't use it, it doesn't cost you anything. Both lines and loans have interest rates, and interest is the cost of borrowing the money. Typically, lines have higher interest rates because they are riskier, and most of the time they're not backed by collateral. Meaning if a bum like you doesn't pay your credit card, there's no guarantee for the person who loaned you the money that they'll ever get that money back. That's different from if you don't pay your mortgage. If you don't pay your mortgage, that's a secured loan. The bank's gonna come and get their property back. So that's lines versus loans, secured versus unsecured. Now a HELOC, a home equity line of credit, is kind of unique because it is both a line, you can use it as you need it, and it is also secured by your house. It is attached to your house. But a HELOC is in what is called the second position, meaning they don't get paid in the event of a default until the first position has been paid in full, which the first position, that's the mortgage company. So the mortgage company gets paid first, the HELOC gets paid second. Therefore, it's more risky. There might not be enough money to go around, and that's why your interest rate on your HELOC is higher than your mortgage. All right, now that all of that garbage is out of the way, let's get into the smoke and mirrors of what velocity banking actually is. The idea behind velocity banking is that you can pay your house off in 5 to 7 years by using a line of credit, usually a HELOC, to make chunk payments on the principal of your mortgage. Basically, if you take a chunk of money that you get from your HELOC and throw it at your house, velocity banking says that you will pay less in interest on the chunk of money that you borrowed than you would on the interest of your house. Now, I know that probably doesn't make sense yet. Let me give you an example. I own a house and I have a $100,000 mortgage and it's at a 3.5% interest rate. My income is $5,000 per month. My living expenses, including my mortgage, cost me $4,000 per month. I have $1,000 left over to save, invest, pay off my house early, buy strippers, whatever I want. Now, velocity banking says if I have a 20K HELOC, I might take 12K of that and make a chunk payment towards the principal of my mortgage. Now, instead of paying $100,000 at 3.5%, I'm only paying $88,000 at 3.5%. The magic happens when it's time to get paid. Instead of taking my $5,000 income and putting it into my checking account, I put it directly into the HELOC, so the balance on the HELOC, the home equity line of credit, goes from $12,000 down to $7,000. Because math, but I still have to live. So I put all of my living expenses that I can on a credit card. I pay everything else out of the HELOC. Eventually, when my credit card bill comes due, I pay that out of the HELOC. So I basically have converted my HELOC into a checking account. So for this whole month, I pay all of my living expenses out of the HELOC, which is $4,000. So now the balance on my HELOC has gone back up to $11,000. $11,000 is $1,000 less than $12,000. I have lowered the total balance of the HELOC by $1,000 because I used the extra $1,000 from my budget to do that. I rinse and repeat this process over and over again until I have successfully paid off the entire balance on the HELOC. At 12 grand, $1,000 a month, it's gonna take me 1 year. After I paid off the entire amount of the HELOC, I do it again. I make another $12,000 chunk payment. I do that process process over and over again, and what do you know? I've paid my house off in 6 years. Sounds pretty great, right? You paid your house off in 6 years. That's amazing. If you spread it out over 30 years, it would have cost you $161,000. Well, you did it in 7 years, saving yourself 50 grand. You're amazing. OMG. Best strategy ever. How do more people not know about this? I saved so much money. You're like a finance hacker. You tricked the banks. You cracked the code. You did it. You've arrived. Yeah, except you did all that work to barely save any money. What do you mean? I thought you said I saved 50 grand. Here's the golden question when you're considering velocity banking. You ready? How much does velocity banking save you versus paying an equivalent amount extra per month on your mortgage? Meaning, instead of running all your money through this HELOC and having to do all this smoke and mirrors and move all those pieces around, what if you just paid $1,000 extra a month on your mortgage? Everything else was the same. You just said, hey, with this extra $1,000, I'm gonna put it towards my mortgage. If you watch any videos on people who like velocity banking, nobody actually does the math of what it saves you. They always say you can pay it off in 7 years and look how much you saved over what it would cost you over 30 years. There's nothing special about it. Let's look at the math. I did the math. The total cost of a 100K mortgage at 3.5% that you paid off in the first 6 years is $110,484. Now, once you paid off the HELOC, which is $12,000 paid off at $1,000 a month, we'll assume a 5% interest rate, which is generous. That's $325 per year times 6 years, $1,950 in total. Add it all together, the velocity banking strategy will cost you $112,434. That's the velocity banking strategy. Now, what if you didn't do that and you just took that same mortgage, 100K, 3.5%, and you paid $1,000 extra a month? You avoided the HELOC altogether. What's your total cost at the end of the day? $111,820. You genius. You are here. You want to do things that put you here. Now, in defense of the velocity banking nerds, most HELOCs are charged based on the average daily balance, which is impossible to predict. So in a real life scenario, there might be slightly more savings, but it's a couple $100s at best. It's not $10,000 in difference. Really, the whole point that I'm trying to make is the amount that you save on the velocity banking method is a joke compared to the amount of risk that you are taking by doing it. What risk is involved? Well, for starters, the bank can call your line of credit at any time. There's no protection, meaning, hey, we want our money back. They would never do that. They did it in 2008. And let me tell you, if banks are starting to call in their line of credits, that means there's a problem. You're not just gonna be able to go to a new bank and get a new one. You're gonna have to pay. You're screwed. Now, if a HELOC is guaranteed by the value of your home and the value of your home goes down, guess what? The bank doesn't want that HELOCs on the books anymore. Now, it would really suck if they made that decision right after you made a $12,000 chunk payment. Line of credit rates are established by the bank. There's no federal regulations. They can charge you whatever they want. You can also start with a 6% interest rate and it can shoot to 20. There's nothing to stop it from doing that. It's unlikely variable interest rates aren't that volatile, but guess what? That's what caused the last housing crisis, among other things. If the rates do shoot up, this strategy is going to end up costing you money. But guess what? If you did a 30-year VA, FHA conventional loan, it's the same thing every month for 30 years. It's never gonna change, guaranteed. Your payment is the same for 30 years. There's not all this risk of what could happen or if the bank does this or variable interest rates shoot up. This also requires you to be really disciplined for a really long time. Now, I'm pretty disciplined when it comes to finances, but every once in a while I take my shirt off and go crazy. Now, if I wanna go crazy on the conventional plan, guess what? I just don't pay extra on my mortgage this month. If I go crazy 3 years into the velocity banking plan, I can mess it up so bad that I can never recover, and now the last 36 months was a waste. The only way that velocity banking can be considered as a somewhat legit personal finance strategy is if you approach it from a behavior standpoint and not a financial one. It's not a good financial move. It's just not. But if you're looking for stupid strategies to accomplish your goal, this is one. Kind of like eating cigarettes to help you lose weight, or posting pictures from 3 years and 50 pounds ago on Bumble to procure a more attractive mate, or using the Bible to conform your wife into submission. It might work, but you're an idiot. Velocity banking might work, but you're an idiot. If your goal is to pay off your house in the next 7 years and you think this smoke and mirrors is what you need in order to accomplish it, it might work, but you're an idiot. If you like the content, consider liking and subscribing to join the Tank Top crew, and I'll see you next time, peasants.